successfully. And there we are. So good morning, everyone. Welcome once again to our weekly webinar, Lessons from the Lockdown. As I said a few moments ago, the way things are panning out with future lockdown coming in from Spain and quarantine, we might have to at some point change this to Lessons in the Lockdown 2 if we end up having a second one, but hopefully we won't hit that far. So again, thank you much for joining today, and my co-host John Corey is with us, and our special guest Ayesha Ofori is also with us. And Ayesha, you can join in the discussions about the market as well, even before we get to your guest slot. So feel free to add your experience and knowledge into that section. So before we just kick off, then let me remind everyone we do not use the chat box. If you have a question or you want to make a point, and we do encourage that from the attendees, then please use the Q&A, and one of the panelists can pick up the question and then bring it in at the appropriate time. And if there's a question we don't get to, then we're happy to follow up. So please use the Q&A, and I say we do want people to give their experience. We have a number of attendees on the webinars who are professionals in their own right, and we do want you to be involved, be interactive. So this is our kicking off. John, any initial comments, any hellos, anything new in the world of John Corey?
Not particularly. I think what's interesting is we're in a constant state of change, and every week is sort of like a mini adventure. But at the same time, my wife was commenting, I've noticed that, wow, time's flying along. It's almost like it's going faster, and yet it feels like I don't get out that much. So.
Yeah, no, that's interesting. So in terms of our brief market update, I thought it was interesting that looking at, you just type in update property market, and some weeks it's all doom and gloom. Forecasts have gone off the edge of the cliff and prices crashing in the property market and all the problems. And then, of course, a couple of days later, everything seems to be very rosy. Everyone's predicting, the recovery. So here's the trend at the minute. The pendulum has swung over towards the UK house prices on the rise in June. Financial Times. So what do you think, John? What's your take on the current market?
Well, one thing people have to be careful about is reading the actual words. House prices, which means the asking price. We're not talking about sale prices, which have been agreed. And in a very healthy, normal UK market, 1/3 of all agreed sales never complete. So, are we looking at a very early indicator that's very subject to emotion? Are we looking at hard numbers based on land registry data of finished sales? So if the asking prices are up, that just means the sellers think they can push it, or that the agents have talked them into it. It doesn't mean the buyers are buying. I don't know what's going on. I'm not that active in the market, in the sense of actually more trying to be a seller right now of a property, and we're getting mild interest, but it's probably specific to that property. So read the details. Also understand that sometimes the people who write these articles, they wrote yesterday about a guitar, and tomorrow it'll be about the new art exhibit, and then in between they do a property article. So there are some people who are less good at understanding what they're being told from Savills or whoever they're quoting. Also, there's certain forums or platforms or individuals who want to be heard, so they'll say whatever it is that gains attention. There's an economics firm that's famous for predicting doom and gloom all the time. They've never been right in 20 years that I've seen their stuff, but they do get quoted because they're the doom and gloom merchant.
Yeah, that's interesting. Ayesha, I'm sure you've looked at many an article and analyzed property over the years. So what's your sort of take on the current situation right now in the UK?
I think there are going to continue to be what I call sort of swings and roundabouts. The market is particularly volatile. The government doesn't seem to know what's happening from one day to the next. So how is the market? I think there are going to be consequences from a second wave. People seem to have forgotten about Brexit. That's going to come back towards the end of the year. So there are a lot of things on the horizon that are going to bring additional volatility into the market. So I personally wouldn't get too excited about these headlines. The other thing I'd note is that, when it says UK house prices rise, they're taking an average across the whole of the country. It doesn't mean that in a particular area the market isn't being hammered. So, whether you're an investor or a developer, you always need to do sort of local market research. And I just tend to find that headlines in mainstream media tend to create a lot of noise. Worthwhile reading, but to some extent taking with a pinch of salt. You always have to do your own analysis at the local level.
Yeah, no, very good. And we often laugh on this,
To
John.
play off.
Yeah, go ahead.
Well, to play off of that slightly, Ayesha said it's good to read, because if a lot of other people are reading it, you need to know why that's the backstory and why that's what people are saying. It doesn't mean you have to agree with it or embrace it, but if lots of the population is, then you at least know where they're getting their information from.
Yeah, and what's also forming their opinion on kind of they're the buyers and sellers primarily in the market. So yeah, that's been their view of the property market, for better or for worse, has very often been driven by mainstream media and what people read and see. And it's just, as we've discussed many times, John, it's ironic that on any one given day, you could find a couple of stories on a positive slant and some stories on a negative slant, all based on exactly the same information. So that's just the nature of the beast.
I think it's always interesting, as John said, to understand what the masses are doing. A personal viewpoint of mine is, generally speaking, I tend to say, right, if the masses are doing X, then I should probably be doing Y or Z. And then I look at what Y or Z can be. So, as I said, it's helpful to know what others are doing, but you don't necessarily have to sort of fall in line. And I find in most cases, it's better to find your own reasons for investing or not investing, not just based on what's being said in the media.
Yeah, no, very good. And you make a very valid point, Ayesha, about Brexit. So that again is something that we'll be discussing again in the months ahead. And it's a very good point. So before we get on then with our special guest today, just to remind everyone that next Tuesday night, that's the 4th of August, we have a project webinar. This had been scheduled for Thursday. We've put it back to next Tuesday. And this is the Curation Tech 99 guys, Hitesh and Ray. And this is their 5-house development up in Plough Hill View in Nuneaton. So you can take a quick snap of the slide if you want. You can see the link, which allows you to register. And this is literally 50 minutes to an hour in depth on this project. Hitesh and Ray, I think one of them are actually planning to be on site. So the idea is that you'll actually get a live look of the site as it is right now and a bit around the area, which I think is really cool that they're taking the time and effort to actually go on site. So this is going to be a good opportunity just to review this project, have a look and see if you're an investor, it's something you can look at and see if it's something you might want to invest in. So that's next Tuesday night, 7 p.m. and you can get the link on our social media, or you can see the link there on the screen and join us if you can. So let's get on with our special guest today. Ayesha was on the call a few weeks ago as we gave some updates about Leo crowdfunding. So I know there are a number who are on today who weren't on that call. So Ayesha, delighted to have you on. I'll let you start off initially just by giving a little bit about your background, and then we'll get into some questions about investor psychology.
Sure, thanks, David. So I think the slide is pretty comprehensive, but I'll give a brief summary. So I always say sort of ultimately I am a scientist. I studied physics. And I say once a physicist, always a physicist. But then I went into investment banking, joined Morgan Stanley pre the 2008 financial crisis initially in their IBD investment banking division in their M&A team. I was then rotated into the tech team and finally into their real estate investment team, where I spent quite a lot of time working on one of their Mez Trust funds, looking at their distressed assets and distressed portfolio. After I left the investment banking, I spent 2 years at London Business School doing the full-time MBA. At that point, I thought I was going to take a different trajectory when I graduated, but I ended up staying in finance, and I joined Goldman Sachs, where I was an ultra high net wealth advisor to ultra high net worth individuals. And what that means is at Goldman Sachs, the threshold for a client is that you have to have investable assets of at least $10 million. So typically clients would have sort of at least sort of 50 to 100, but our clients were very varied and would, many of our clients were billionaires. And essentially my role was to manage their assets. So to decide on a suitable portfolio or how the assets were going to be managed in order to meet their goals, then to actually invest and manage those assets on their behalf. I was promoted to executive director and I stayed at Goldman for 6 years. I resigned in 2018 to pursue a full-time career in property investment. Started out initially, whilst I was at Goldman, building up a property portfolio with my husband, which we're still growing and run today. But also I started a number of property-related businesses. So the first is Axion or Axion Property Partners, which is working with high net worth individuals who want to invest into residential property. So very similar to Leo effectively. Which is actually one of the reasons why, David and I joined forces. Also started 2 property investment communities, Propel Network, which is a property investment community for women. So we help women who either are new to property investing and want to get in, or those who are experienced, but they're looking to scale, or they have a particular problem, they're looking for funding, they're looking for, the right team or whatever it is. We provide a supportive community for women who are in property to flourish. And Black Property Network, whilst it sounds quite similar to Propel, is very different. That's more around focusing on sort of financial literacy, but we do help people to increase their sort of financial literacy and financial stability, but through property investment. So I say, yeah, that's me in a nutshell. I am very busy, but as everything I do is related to property, there are a lot of synergies. Someone said to me, how do you manage everything? But I said, it's not as if I'm a doctor, an accountant, a solicitor. Everything I do is property because it's what I live and breathe.
Very good. No, excellent. Thank you for that. Just before the lockdown, you'd asked me to speak at a Propel event and a Black Property Network event. I think there was like 60 women at a house in London, and then there was like 120. I think the room was packed for the Black Property Network event that I attended. And yeah, it was interesting to see the appetite for education and the desire to network, and certainly there was real energy and vibrancy about those 2 events.
Yeah, I think property investing is something that, particularly in this country, we have a passion for. And I think that many people have historically thought that perhaps property investing wasn't for them, or even turning it into sort of a small business or a larger business, because people inevitably feel that you need a lot of money to get going. And if you're not wealthy and you don't have any money of your own, then how do you go about it? That's usually one of the biggest challenges that I think people find, which I guess is quite timely given, what Leo does and why we're here today. The money is out there. It can be found. It's just about knowing how to do it and where to find it and how to manage those relationships.
Yes, indeed. And that brings us on nicely to the topic today. And I thought it was relevant that you spent a bit of time explaining your background, because that obviously means or gives the credibility that you do know what you're talking about when it comes to investor psychology. You've lived and breathed that for many years. And I should say straight up front, both Ayesha and myself are approved persons on the FCA register and list. So anything that we talk about today obviously is not intended to be investment advice. We don't give advice in any way, shape or form. But clearly Ayesha's background has been in this market, and she has a lot of very relevant information and experiences to share. So just with that caveat, we'll deep dive into some of the investor psychology. No doubt John will have a couple of questions and angles to go off on as well. So the first one there really is, why do so many high net worth and sophisticated investors invest in property? What's the attraction of property as an asset class?
So I think, one of the reasons I feel is, as I said, in this country, it's something that we've historically been very crazy about, and I don't see that changing anytime soon. We are an island, so land is constrained, but I think one of the biggest factors as to why property is so interesting to a lot of people is because, historically, if you look at how a lot of people have made their wealth, it inevitably comes from property, whether that's directly or indirectly. When I was at Goldman, a lot of my clients would have other businesses or other ventures which they sort of saw as their primary source of income. But when you actually dig back and you look at the numbers, a lot of that would come from real estate, whether it's the offices that they had, or it would be property that they'd inherited. A large portion was always real estate. And for me, if you look at the returns that property can offer over a period of time, if you use leverage, it's very difficult to get similar returns, I feel, from other asset classes. So just, in terms of the risk reward metrics that it offers, it's very, very attractive.
I like that word. I like that word leverage that you use. I think that's a really key word. Maybe just elaborate on that just slightly as to the benefits of bringing leverage to play.
Yeah, so I mean, I'll keep it simple, but fundamentally, if you use debt, or you invest in property with a mortgage or money from a lender or just anybody else, and you pay a return on that, that's essentially giving you more firepower to go out there and invest. And the aim of the game is always to, wherever you invest, for your investment returns to be more than what it's costing you to borrow the money. So effectively, you're able to make returns on money that isn't yours. And I think that's one of the beauties of property. Now, in certain other asset classes, you can also use leverage. So for example, if you do invest in equities, you can invest in structured products, you can use leverage. But the interesting thing that I find with property is, if you, for example, you buy something with a mortgage and then, house prices go up, then you can actually, remortgage or take some of that value out. And that's additional capital for you to then go on and do something. If the market falls, the mortgage provider doesn't call you back and say, right, the market has fallen, we want some money back. So if you don't sell or you don't remortgage, and you don't sort of mark to market or crystallize that loss, it's effectively a paper loss. Whereas in equities, for example, if you use leverage and the market falls, you can have a margin call. You would actually be asked to put more money in. So again, when I'm comparing those two things, I find that with property, you get a lot more on the upside, and you don't have as many of the sort of what I call downside effects. So that's another reason I feel why property is particularly interesting as an investment asset class.
Excellent. Okay. And again, just remind the attendees, if you have any questions for Ayesha, by all means, fire them up there, and we can put them to her. Anything related to this topic, or indeed anything to do with property, feel free to put your questions up. And again, even if someone has a comment or an observation, and that's relevant and beneficial to the attendees, then by all means, get it up there for us, so we can share that. So the second part of this question, and then I'll let John come in with a steer. But what, in terms of these high net worth people, sophisticated investors that you obviously worked with in the past and continue to work with, how do you find, or what do you find they look for in a property investment? I'm guessing well, I know it's different than, say, a retail investor who's starting off on their first buy to let. In that market, what do they look for in an investment?
It really varies. This question is a bit like, how long is a piece of string? Everybody will have different things they're looking for. Everybody will have different investment goals, different amounts that they're investing with, and even different ways that they want to use the property. So for example, I know of individuals who will only buy in cash, who will buy prime London properties because they are literally using it as a bank account. They're using the property as a vehicle to park cash because their bank actually charges them for holding money. Now that's a great problem to have, but I guess not common for a lot of people. So for the majority of other people, they're looking for something that is either going to provide them yield or capital appreciation, or both. And effectively, it's about, in the mainstream, sort of investing for the long term. There are individuals who invest for the shorter term and will sort of do, you know, refurbs and flips. But I'd say on the whole, if you're a high net worth individual, you tend to want to find an investment for your money where you're not sort of churning regularly, because typically when you churn, it either takes a lot of input, which means you're going to have a team that you're paying to do that, or there are going to be, you know, fees involved. So, you know, I've known again of individuals who will have a large pot of money and they'll say, right, I want to, you know, build up a large portfolio, and then they'll go and seek help to do that. There's something very interesting that I've noticed, or I've seen start to happen in, I'd say, sort of the last sort of 12 to 18 months, really. Historically, I would have said that residential property wasn't what I called an institutional asset class. So, for example, if I go back to my clients at Goldman again, many of them who had real estate investments, they would have been through real estate funds, or they would have been sort of into commercial property, but nobody was really investing in residential in a meaningful way. That has actually started to change. And it's not just high net worth individuals, it's also institutional funds are starting to look a lot more at the residential sector. Now, the issue previously was that if you have a large pot of money, say you have, I don't know, 50 million or 100 million, and you wanted to deploy that into the residential sector, but you wanted to do it in the areas where, say, the average unit prices are £100,000, that's a lot of work, because you would have to be buying a significant number of properties. And historically, there weren't really ways to do that efficiently. Whereas now there are actually quite a lot of companies that are starting up that have used technology and various other things that enable them to be able to manage high volumes of properties. So what I've started to see now is a lot of high net worth and funds starting to get into the resi space. So I think it's going to be interesting as that money sort of continues to trickle in over the next sort of months and years as to the impact that it has on the resi space.
Yeah. Okay. Brilliant. A couple of questions coming in. I'll take the first one. I'll let John take the second one. So in terms of the first one, is coronavirus presenting any unique investment opportunities for you and your investors?
Oh, absolutely. So as I said, my background was personally in terms of property investment was just focused on residential. I hadn't really considered commercial before, but I'm starting to look at it now, and that's just purely because of what we've seen during lockdown. So if I walk and look at many high streets, a lot of shops are still closed. A lot of them won't reopen. And, you know, many of them come with residential units either above or behind. So I think there's an opportunity out there to start picking up some of these retail units that can be repurposed to include resi. And then particularly with the government becoming more relaxed around sort of PD rights, I think it just means that it's a fantastic opportunity to pick up assets in the market, just given what's going on, and repurpose them. So that's something that I'm personally looking at the moment. Yeah. And then I think generally for just high net worth investors, for those that are sophisticated, volatility is good. You know, when the market is flat and there's no volatility, you can't make money. You need vol to make money. So in markets like this, people will be ready, will be active, will be looking for the great opportunities to invest.
Good point. Good point. Okay, John, do you want to come with one of the questions?
Well, it's actually just a question for Ayesha also. Is there a typical method or metric that you use to measure a residential deal? For example, do they focus on net yield or some other key variable?
So again, I think it really depends on who the investor is. And I know this is a conversation that David and I have been discussing recently with one of the projects that's about to come onto the platform. So I think for most investors, they consider, or if they're going to sort of use a benchmark or a way to measure their return, it's usually ROI, so return on investment. And this tends to be the standard in the, what I call sort of, you know, the average property space. But in the you know, financial investment world, when we're looking, or typically when we're looking at investments and returns, we look at metrics called IRR, so your internal rate of return. The way that they're calculated is slightly different. So with my sort of property hat on, I tend to focus on ROI if it's an investment that is focused on capital appreciation, and less so on IRR. However, I do bear the IRR in the back of my mind as well, because that was essentially how I was trained to look at investments and how to measure them. If it's an income play, then I focus more on the yield, and then any capital appreciation or upside I consider to be a bonus.
Okay. We're down the last sort of 5 minutes. John, any observations or comments or questions for Ayesha?
Well, I think a couple of things Ayesha's touched on, which maybe with her sophistication, she knows the subtle differences, but I want to highlight for those that don't have her academic and professional background. So while it's true that if you have a loan on your house and the value drops, you don't get a call from the bank saying you have a margin call, you need to put up more cash in 24 hours or in 40 days. That actually, margin call actually exists in most commercial loans for commercial real estate. So there have been some people that have caught out, particularly those that are on HMO mortgages that are based on the cash flow. And if their rents drop or the perception of the rents drop, because these are just up valuations, then they do get margin calls. I know one relatively famous guy in this sector who had a very large margin call. And it was like, do you want the keys, or do you want to figure out a different way we can handle this? And the other thing is, as a country of homeowners, well, it actually started with Thatcher, roughly when the banks changed. So when the current queen was taking the throne, 70% of the country actually rented, or something like that. There's an old FT article about this. And it's a country of renters, but it's more modern phenomena that we think it's a country of owners. And there's a lot to be said for, if enough people believe the same thing, it doesn't have to be true. Donald Trump got elected because he's going to change the world. Well, he got elected. That's the result, not the change. So you can believe a lot of things. You just have to be careful about, is your belief grounded, and is it the masses believe it, but they're fickle and they're going to move to something else. So look at the numbers, look at the details, look at the demographics. I tend to say for residential, if the population's growing, if people have careers, I don't mean jobs today, but careers, then that city or community will do well. If the population's falling because the industries have all closed, the mining areas and things like that, I don't care what the macro environment is doing, the local market's going to be in the proverbial brown stuff.
Yeah. Okay. Ayesha, I'll give you the last sort of 30 seconds before we do the last few slides, just to wrap up, or any last comments you want to make.
Yeah, I guess they say that, I mean, real estate for this country has always been an important asset class. I don't think that's going to change anytime soon. It's the asset class that I focus on both professionally and personally. And I'd say to people that, there are always going to be opportunities out there, particularly, as I said, when there's volatility and markets are like this. So try not to be swayed by the headlines, try not to be swayed by the general mood, make decisions yourself, do the sort of analysis yourself, because oftentimes I find it's in times of crises where you can really maximize your return potential.
Brilliant. No, absolutely fantastic. I think that was a really interesting insight, and we've on the weekly webinars so far, we haven't had that angle as yet. We've had a lot of fundraisers on and things like that, but I think it was very, very beneficial and valuable and interesting to have your kind of experience and take on the market. So thank you for joining us today.
My pleasure.
Okay, so last couple of slides then to wrap up. These are on our platform as coming soon projects. So I've mentioned the Plough Hill View development. So when it goes view deal, you'll be able to see a pitch page and see the information, and again, drawing people's attention to the forum where people can go on and ask questions and interact directly with the fundraiser on our forum. So this will be quite soon on the platform. Then we also have the project after that was coming is the Target 5 HMO high targeted yield product. It's on its way and will soon be able to be viewed. And then we also have a YieldWise raise coming for some buy-to-let property in the Northeast. So again, just reminding the attendees, this will all be on our platform very soon as it finishes DD and checks, etc. So you can keep an eye out for these as they come. I thought what I would do for next week, because we've got a really interesting guest the following week and a couple lined up, but I thought what I would do is throw out today, is there any topic that the attendees would like us to cover next week? So if you get back to me today on that, if you want to either quickly fire something in now, but I'll reach out to myself or John on a one-on-one, and let's see what those that come on the webinar every week, what you would like to hear about, or is a particular guest you'd like to try and get us on, then let us know. I thought that would be a good thing rather than just John and me picking topics every week. So I look forward to the feedback on that, and let's see who would turn up. Now, if you ask for Boris Johnson or Donald Trump, that just may not be able to happen. John would love to have Donald Trump on here, I'm sure, and ask questions, but that's not going to happen. So someone that's realistic for us to be able to get, please. So last slide, reminding people, those who are interested in having a further consultation with myself and John. We often say that debt is not so easy, but certainly equity can be harder. And certainly what Leo crowdfunding does is very much focused on providing the equity part of the capital stack for fundraising needs. So for anyone who does want to have a further consultation, John, I do have some packages where we can work with you directly. And there's the information on the screen. So that really wraps it up. John, any last minute comments you want to make?
I mean, if people have a recommended person that they wanted to hear speak, fine. If they just have certain questions, send in the questions. Possibly it'll be a little bit Q&A-ish based on what you want to talk about. That's not driven by whoever David or I picked to be that week's speaker. So let's have an audience-led week next week.
I think there's one that's come in already. So
yeah. Future topic: case study of a smaller startup investing through crowdfunding platforms to build significant wealth and cash flow. Yeah. Okay.
Cool.
Yeah, that sounds like an interesting one. So we can. I can see John smiling at that one. That's up his street. It's exactly the sort of thing he likes to talk about. And he's already clicked to say, "I'll take that one." So yes, that might be the way we do it. And again, thanks for the comments from some people coming in saying they've enjoyed it today and informative. So listen, guys, thank you very much, everyone who's joined us. Once again, I'm sure you've got value. Big thanks to Ayesha for joining us today, and also to the weekly resident, Mr. John Corey. So wish everyone a successful rest of the week. And of course,
bye, everyone.
In the current climate, stay safe. All the best, guys.
Bye.
Bye.